Welcome to RenMac Off Script, where we often discuss markets, economics, policy, history, and life. It's the 23rd of February, 2023. I'm Jeff DeGraff.
I'm Steve Pavlik.
I'm Howard Mason.
Howard Mason. So Howard Mason is our banks analyst and handles global central bank balance sheets for us. And he's going to talk to us a little bit about what's going on. So he's replacing Neil Dutta this week, who is on vacation. We think still floating somewhere in the Caribbean on a Disney cruise, but we have not yet heard confirmation, mostly because there haven't been any New York Post articles claiming that he's done something rash. As a reminder, all the charts we reference are posted to our Twitter account at RenMac LLC, and you can go to our RenMac Access page if you're not an institutional client and would like to see more of what we do here at RenMac. Steve, I'm going to start with you. We do that often, but the CBO came out with some projections last week. You had a very good chart on that, which we'll put up on Twitter. Just give us a little sense as to what's going on. I know this isn't new news, but it's certainly relevant news, and we're going to work Howard into this as well. But what was the punchline from what the CBOE had to say about all things debt related?
It's just reaffirmation that the U.S. has a very depressing outlook with respect to debt. And you could probably make the case that the Congressional Budget Office estimate may be more generous, because one of the things they have to do in making their 10-year forecast is the assumption that all the current policies in place will remain that way through all the 10 years. And if you've been listening to us and following our work, you'll know that next year, one of the big legislative items that's going to dominate the Congress and administration, regardless of who's in charge, is going to be the expiration of the Trump tax cuts on the individual side. I think everybody believes that there'll be some extension, even the Biden administration has suggested, of at least those making less than 400,000. Obviously, if you have Trump in office and a Republican Congress, you can probably see a clean extension. That's going to only add to the debt. And I think the things that really jumped out at me is we're finally at the point where interest costs exceed what we're spending on defense. And the other thing that was notable was the fact that the initial estimates for the energy related provisions in the Inflation Reduction Act were grossly inadequate. I mean, we're talking about more than double what they were. And part of that may have been by design by the administration, in the sense that they've changed some policy since then to make them more attractive. So maybe if you want to be skeptical, conspiratorial, that they sort of, when they pushed it through initially, that joint committee on taxation, in terms of how it was applied with the existing rules and regs, thought it would be one thing. Now that they've modified those, it's going to be a lot more. Again, the biggest drivers here are still entitlements, and there's no political will to address those in the near term. So that's sort of that depressing outlook that Phil Swagel provided.
Yeah. Well, let's think about this in terms of the global context. And Howard, I know you're very up to speed on this. One of the countries that's been kind of down this path even before us was Japan, and things are changing there as you see it. Tell us a little bit about what you're seeing in Japan, and then how that might relate to what we should be expecting here in the U.S.
It's interesting. One of the surprising things about Japan is it has a very high debt to GDP ratio of well over 200%, and has done for many, many years. But the economy has managed or is beginning to exit a sustained period of difficulty. And it does raise the question of what the true upper limit on fiscal sustainability really is. Regardless, as you probably know, Japan has been in the news because its key stock market index, the Nikkei 225, hit a record high, and that exceeds a peak that was last reached in December 1989. And there's a good chance this is the beginning of a sustained run in Japan because of a secular change in the economy, and in particular, the end of deflation that has lasted over 20 years. Inflation right now is running at about 2%, a tad under the central bank's target of 2%, in fact. But the head of the central bank, Governor Ueda, has said on Thursday that he sees inflation increasing as tight labor markets push up wages. And we'll get more information on that through the seasonal wage negotiations that happen in Japan in spring. And as you exit a deflationary period, you get an increase in confidence. Your bank profitability increases with rising rates, and so banks lend more. business investment increases, consumers become more confident and are more inclined to spend. And all of that is contributing to this lift in the equity market. And we expect that to continue. I think the only potentially negative fallout of the change in Japan is in the fixed income markets. As Japanese rates rise, Japanese bonds will sell off. And that will be important globally because low Japanese rates and indeed a negative policy rate in Japan have been an anchor for bond yields around the world. And obviously we're losing that anchor, which will put upward pressure on yields, including in particular upward pressure on yields on US Treasuries.
So, right. And, you know, is this just extraordinarily bad timing that we've got these, you know, massive fiscal issues here in the States at the same time that this unanchoring is taking place in Japan? Or is it just kind of the culmination of the post-COVID and Japanese deflationary policies?
I think there are some things coming together that put upward pressure on US rates. It's not bad timing so much as you point out, unwinding the policies that were put in place in the US to deal with the pandemic. And of course, one of those policies was quantitative easing, where the Fed bought large amounts of bonds in order to keep rates low and provide a monetary stimulus to the US economy. And the Fed is unwinding that through a process known as quantitative tightening, where it allows its bond portfolio that currently stands at about $7 trillion to decline over time. But if you combine a reduced rate of Fed buying of bonds and in fact a situation where the Fed is a net seller of bonds in effect, if you combine that with a heavy issuance calendar from Treasury to deal with the fiscal issues that Steve referred to, then that tends to put upward pressure on US Treasuries. And so one of the issues that clients care a great deal about is the pace at which the Fed will slow down its runoff of its bond portfolio. In other words, the pace at which the Fed will slow down quantitative tightening. And it's worth just thinking a moment about that. It turns out the constraint on quantitative tightening is liquidity in the system, because as the Fed allows its bond portfolio to run off, other buyers have to step in and purchase bonds, and that takes liquidity out of the system. And you can't overdo that, because if you overdo that, then you can create instability risks in the financial system. So one of the things we care about is how much liquidity in the system is there and what that does for the timing of this process of quantitative tightening. And just to give you some brief numbers, our estimate for excess liquidity in the system is about $1 trillion. The Fed is reducing its bond portfolio at a rate of about 95 billion a month. And so that gives you runway of around 10 months. And the upshot is that we expect the Fed to slow the pace of quantitative tightening towards year end. And that will represent an important shift in monetary policy. It will tend to increase yields on US Treasuries and will, to some extent, counteract the positive impact on the economy of expected cuts to the Fed's policy rate.
Yeah, I think it's interesting because so many people are focused on the Fed and the policy rate, but there's so much happening underneath the surface, you know, in terms of what else is the liquidity drivers, not just the rate at which people pay, but also, you know, just the size of the balance sheet and where those excesses are placed. Obviously, we'll have to keep watching that. You know, our yield impact model right now for equities is in the 9th percentile, or 90th percentile, I should say, 9th decile. It's not a point yet where that impacts negatively equities, but with equities on such a torrid pace, I think it's going to be very important that we monitor or continue to monitor these 10-year yields and just see exactly what the impact will end up being on equity prices as we go. I think everybody, you know, in this room believes that you know, the equity markets have been pretty resilient in terms of the higher rates. Obviously, there was an impact about this time last year, but you know, even then, the rates have continued to really kind of defy what you'd otherwise expect out of equities. So is there a timing issue here, Howard? How should we think about that? Where is kind of the critical point where you see this issuance versus the quantitative tightening from the Fed? Is there a point that we really need to be monitoring and aware of when that the potential to tip the apple cart might take place?
I think so, Jeff. The measure that we key off is the level of bank reserves in the system. So just to clarify what I mean by that, banks hold deposits at the Fed because the Fed is, after all, a banker's bank. And those deposits are called reserves. And you need a certain amount of reserves in the system for everything to function smoothly. And the Fed has committed to what it refers to as an ample reserve regime. It wants to make sure that there are plenty of reserves in the system so that the system can function well. Now, that doesn't mean that every bank is always going to have ample reserves. Mismanaged banks can run short of reserves, and that creates a problem. Silicon Valley is an example of that. But in aggregate, the Fed is committing to ensure there are ample reserves in the system. And the question is, what is that level? We estimate it's about $2.8 trillion to $3 trillion. Today, the reserves in the system are about 3.5 trillion. And so we watch the decline in that reserve level towards that lower level of comfortable reserves. And I think once we start approaching that lower level of comfortable reserves, then you can expect the Fed to reduce the pace at which it's running off its balance sheet.
Great. All right, we'll keep an eye on that. And obviously, every Monday morning in our Monday morning macro meeting, you cover that for us. So thank you for that, and we'll keep clients abreast of that. Well, from our standpoint, we talked about momentum last week and momentum in the 79th percentile. We start getting worried about equities just from a pure momentum sentiment standpoint when that level breaches the 90th percentile. And you might think with Nvidia and some of these surges that we've seen in the last couple of days that we've gotten there. We haven't. We're in the 94th percentile now. So it's close. But I would say with names like Nvidia, Avago, AMAT, Lam, there's several of them, actually about 25 of them. There's this unique combination. It doesn't happen very often. In fact, I'd say in a normal period, if we get one or two, I'm pretty shocked. That's on a weekly basis. Right now we have 25 of these alerts that we're getting that show this high level of price momentum along with this high expectation of future price gains, and we measure that in the option market. And usually that is a unsustainable combination. It's a point where these equities will either tend to decline, as we saw with PanW, which actually was on that list a couple of weeks ago, or you'll see this elongated consolidation, which is exactly what we saw with Nvidia back in July of last year. So you get these this crescendo, if you will, and the stocks just can't suck in additional buying power. And I think we're there with a lot of these names. So be careful. It's not a big top necessarily. It just ends up kind of tempering the consensus or the bullish opinion. And it does tend to lead to frustration for those bulls. So at the margin, we are not buyers of those names because, again, it tends to be a little bit more dangerous situation and a little bit more of a consensus call than anything else. So that 84th percentile for momentum, not yet in the 90th percentile, just selective for individual names. 20-day highs yesterday spiked right around this 25% level. We like to see numbers in at least the 40s. Anything above 50 is fantastic, but that'll be important as we continue to grind this higher to see what the sustainability level is of this rally. If 20-day highs contract as we go higher, that's a sign of vulnerability and really that focus or that concentration that so many have worried about with breadth, but we tend to measure it a little differently. The one area that I would just reinforce our bullish call, because it really is playing out to script, is what we're seeing out of the pharma, biotech, and life science area. Now, specifically biotech and life sciences there, we're seeing relative strength improvement. We're seeing these breakouts, and this is coming after we had this long, or I should say elongated period of negative excess returns in that space. And that's usually the combination of things that we look for to provide these long-term bottoms. It's kind of this washout effect. And even the ETF flows in the biotechs continue to show excess outflows, not inflows, even as we're seeing some of the strength. So that tends to be good news. It's more of a contrarian play, and certainly something that we want to alert clients to at this stage when there's so much fervor going on in tech. There are these opportunities that certainly look to be a lot better from a risk reward standpoint, at least tactically, with life science tools, healthcare equipment, and biotech. The other part of that is obviously the 10-year yield. So as we get above 450 on the 10-year yield, it does start to work against equities. So we want to make sure that we're watching that. Steve Pavlik, let's go back to you in terms of policy. Obviously, it's still an election year. A few things happening for I think both parties in the next week or two. Give us your highlights and what we need to be watching for in terms of the critical elements of this race.
Sure. On the presidential level, South Carolina will be the Republican contest on Saturday. I don't think there's any question that Trump's going to win. I think so. Watching what that margin of victory is going to be, you saw Nikki Haley, former governor of the state, give a speech this past week saying that she's going to continue in the race, despite polls showing her losing anywhere between 30% or so. And I think that usually is not a good sign for a candidate to try to have to make a speech like that.
What's the strategy there? Sorry. Well, I mean, I just don't.
Few things in terms of potential reasons for why she may be trying to continue in the race, even though it looks like a futile effort from the outside. One is just the prospect of an event happening to Trump, be it an act of biology, given his age and weight, candidly, or an act from the judicial branch. He has a lot of legal challenges ahead of him, and I think there's some people that sort of see the opportunity on the Haley camp where if some reason Trump's sort of taken out of the picture, she's sort of the last person standing, so to speak. It's also probably motivated a little, think more maybe by 2028, trying to position herself for sort of I told you so, hoping that maybe after Trump there'll be a desire by the party to maybe return to more the Reagan-esque vision that she's trying to lay out. I think that may be a little bit misguided if she's drinking her own Kool-Aid there. I think what you see is there's support amongst a faction of Republicans for a non-Trump candidate. I don't think that necessarily translates to support for her moving forward. I think there's going to be a lot of resentment from that Trump wing after Trump. She is seen as sort of contributing to his downfall by making candidly more credible arguments against Trump, just given Biden's cognitive ability to do so right now. And look, to try to tell voters that they should look to you in 28 after you lost your own state by 20 or 30%
Right.
4 years ago, I question how compelling that's going to be. And then on Tuesday, on the Democratic side, obviously they're not really competitive primary there either, but that's going to be in Michigan. And that's really important because progressives are actually organizing a campaign there to get Arab American voters, which make up a considerable voting bloc, to vote against Biden. And maybe not necessarily for Dean Phillips, but just to, sort of check present to try to get him to change his policy there with respect to Palestine. And you've already seen Biden, really worried about Michigan, a lot of polls showing him trailing there. I don't think that's by accident that you're also seeing reports that the Biden administration is going to slow roll some of these emission standards on the electric vehicles. You have a lot of auto workers that are concerned about the prospect of losing their jobs. And it's why we say, a lot of questions we get, why you follow the politics, because the politics drive the policy. And that's even more the case in an election year. So if you want to see where the puck is headed, honestly, follow the polls.
Is there, I'm sure somebody polls this, is there a poll that shows Arab Americans, Trump versus Biden historically?
Well, you might recall Trump's Muslim ban proposal in 2016.
Wow.
So I doubt they're going to necessarily migrate towards him. I think the fear is more the stay home option, or you get into this, third party alternative there for Michigan. It's not necessarily that they're going to switch over and vote for Trump. I think what you're seeing in the polls just in general is the third party option is more of a threat to Biden because you just see low approval ratings, concerns about the cognitive condition. And when it's a binary choice between Trump or Biden, he can consolidate the non-Trump vote. But again, when there's other alternatives or simply people just disgusted and stay home, I think Democrats are more fearful that could come at Biden's expense. Just given Trump's support, we talked about it. It's very durable, high floor, low ceiling, 45 to 47%, pretty consistent from 2016.
Yeah, amazing. Well, thank you for that, Howard. Thank you for joining us. And to all the listeners, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter for important updates. And again, if you want deeper insight, join us at renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Steve Pavlik.
I'm Howard Mason.
Great. Thank you. We'll see you.